For decades, financial markets have operated under a powerful assumption. When things get bad enough, central banks will step in. Interest rates will be cut. Liquidity will be injected. Assets will be purchased. Confidence will be restored. This belief has shaped investor behavior for more than a generation. It has influenced portfolio construction, risk-taking, leverage decisions, and even government borrowing patterns. The central bank backstop became more than a policy tool. It became a psychological anchor. But what happens when that anchor weakens? To understand how central banks can lose control, we must first understand what control actually means. Central banks do not directly control markets. They influence them through monetary policy tools, policy interest rates, open market operations, forward guidance, reserve requirements, and large-scale asset purchases. By adjusting the cost of money and the availability of liquidity, they attempt to steer inflation, employment, credit expansion, and financial stability. In normal conditions, these tools are powerful. Lower rates stimulate borrowing and investment. Higher rates cool excess demand. Liquidity programs stabilize stressed funding markets. Communication shapes expectations. Control, in essence, is about credibility. Markets respond not just to what central banks do, but to what they believe central banks are willing and able to do. The modern era of central banking power intensified after the 2008 financial crisis. When global markets froze and major institutions collapsed, central banks expanded their balance sheets dramatically. Quantitative easing programs injected trillions of dollars into the financial system. Policy rates were cut to near zero. Emergency lending facilities were established. These measures stabilized markets and prevented deeper collapse. But they also created a precedent. In severe downturns, intervention would be swift and aggressive. Over time, this pattern conditioned markets. Investors began to assume that risk assets would be supported during stress. The so-called central bank put became embedded in financial psychology. When volatility rose sharply, expectations of policy easing often triggered rebounds. The belief that liquidity would always return encouraged higher leverage and risk-taking. Asset prices became increasingly sensitive to central bank communication. However, central bank power is not unlimited. It is constrained by economic realities, political pressures, and credibility limits. One of the most significant constraints is inflation. When inflation is low and stable, central banks have flexibility. They can cut rates and expand balance sheets without immediately threatening currency stability. But when inflation is elevated and persistent, the policy environment changes dramatically. Cutting rates in a high inflation environment risks accelerating price pressures further. Expanding liquidity when inflation expectations are already unstable can undermine confidence in the currency itself. This creates a policy dilemma. During a financial downturn accompanied by high inflation, central banks may be unable to provide aggressive support without worsening another problem. They face a trade-off between stabilizing markets and stabilizing prices. If they prioritize markets, inflation could spiral. If they prioritize inflation control, financial stress may intensify. Debt levels represent another constraint. Over the past decades, global sovereign, corporate, and household debt has increased significantly. Low interest rates encouraged borrowing. Governments financed deficits cheaply. Corporations refinanced repeatedly. Investors searched for yield in increasingly complex instruments. As debt accumulates, economies become more sensitive to rate increases. Even modest hikes can strain balance sheets and expose vulnerabilities. This sensitivity limits how far central banks can tighten policy without triggering instability. Paradoxically, prolonged easing cycles can plant the seeds of future instability. Extended periods of low rates compress risk premiums and inflate asset valuations. Investors reach for yield. Credit spreads tighten beyond historical norms. Capital flows into speculative areas. When tightening eventually becomes necessary, often to control inflation, markets accustomed to easy liquidity may react violently. The adjustment can be abrupt because leverage has built up quietly over time. Another dimension of control involves the bond market. Central banks influence short-term rates directly, but longer-term yields reflect broader expectations about inflation, growth, and fiscal sustainability. If investors lose confidence in a government's fiscal trajectory, long-term yields can rise independently of central bank intentions. In such cases, central banks face a difficult choice: allow yields to rise, potentially destabilizing the economy, or intervene by purchasing bonds. This may contradict tightening efforts aimed at curbing inflation. Currency markets add further complexity. If market participants perceive that monetary policy is inconsistent or unsustainable, capital can flow out rapidly. Currency depreciation can import inflation through higher import prices. Defending a currency may require raising rates, even during economic weakness. This dynamic has historically forced central banks in various countries into painful tightening cycles during recessions. Loss of control does not happen in a single dramatic moment. It develops gradually through erosion of credibility. If inflation targets are repeatedly missed, communication becomes less persuasive. If policy pivots appear reactive rather than strategic, markets begin to test limits. If forward guidance changes abruptly, expectations destabilize. Over time, confidence weakens. The risk intensifies when fiscal policy and monetary policy become intertwined. Large government deficits, financed indirectly through central bank balance sheet expansion, can blur institutional independence. If markets perceive that central banks are effectively monetizing debt to support fiscal authorities, concerns about long-term price stability may increase. Independence is a core pillar of credibility. Once questioned, restoring trust becomes difficult. Technological changes in financial markets also accelerate transmission mechanisms. High-frequency trading, algorithmic strategies, and globally interconnected capital flows amplify reactions to policy signals. A single, unexpected comment can trigger rapid repricing across asset classes. This speed compresses decision windows and increases volatility. It is important to clarify that central banks rarely lose control entirely. What changes is the degree of influence. Markets may begin to move in directions that policy tools struggle to counteract without generating undesirable side effects. Inflation may remain stubborn despite tightening. Long-term yields may rise even during asset purchase programs. Currency volatility may persist despite interventions. In these scenarios, central banks are no longer setting the tone, they are responding to it. History offers examples of such tensions. Periods of stagflation demonstrated how inflation and stagnation can coexist, limiting policy flexibility. Episodes of sovereign debt stress have shown how bond markets can pressure governments and monetary authorities simultaneously. Emerging market crises have illustrated how currency depreciation and capital flight can overwhelm domestic policy efforts. The broader lesson is that control in monetary systems is conditional. It depends on trust in institutions, coherence between fiscal and monetary frameworks, manageable debt burdens, anchored inflation expectations, and functional financial plumbing. When several of these pillars weaken at once, central bank influence diminishes. For investors, the assumption of perpetual rescue can become dangerous. Markets that rely excessively on intervention may misprice risk. When policy constraints tighten, repricing can be swift. Volatility can increase not because central banks disappear, but because their room to maneuver narrows. Ultimately, the question is not whether central banks are powerful. They are. The question is whether structural conditions allow their tools to operate effectively. In environments of high inflation, elevated debt, political polarization, and fragile liquidity, policy trade-offs become sharper. Decisions carry heavier consequences. Credibility becomes more valuable than ever. Control in the end rests on confidence. Confidence in currency stability. Confidence in institutional independence. Confidence that policy decisions are forward-looking and coherent. Once that confidence erodes, restoring it can require painful adjustments. Higher rates, fiscal consolidation, or prolonged economic slowdowns. Central banks do not lose control in a dramatic surrender. They lose it when markets stop believing that intervention will restore balance, without creating a new imbalance elsewhere. And in a world built on leverage and interconnected capital flows, belief can shift faster than policy can adapt. Welcome to Cash and Chronicles, where money, power, and history collide.